So I've talked quite a bit about insurance companies and how I like insurance companies, and there's quite well, not a ton, but there's a handful of them that I like. Obviously, I've talked about Primerica before, Kinsale Capital I also like. WRB is another one that I've started buying recently. This is WR Berkeley, $21 billion, actually closer to $22 billion company. The dividend yield is low, but they're growing it fairly well. I'll get into that in a little bit. 15% free cash flow yield. That's something that is really, really, really good. Like that's a phenomenally good free cash flow yield. Earnings yield just over 7%. That's good. Obviously, I don't need to get into what they do. They're an insurance company, but they are throughout the U.S., Asia, Australia, Canada, Europe, Mexico, Scandinavia, South America, and the U.K. So they're very well diversified, which honestly, up until very recently, I did not know that they were that well diversified. So that's very good to see. If we get into the details here, let's get right into it. Profitability, they're decent. Operating margin 19%, net margin 12%. Typically, I don't think insurance companies are going to have insanely good margins, because if they're charging too much, chances are people are going to go to their competitors. So they do have to keep things fairly reasonable to stay competitive. They're not like a tech company or something like that where you can see like a 50%, 60% operating margin, right? That's just crazy. Obviously, I'm sure it exists somewhere, but I don't think that's manageable long term. If we look at its growth, it's actually pretty solid. I mean, revenue is growing fairly nicely. Net income is growing fairly nicely. If we look at financial health, they're decent. Analysts also, again, earnings are expected to grow 50% next year. Revenue expected to grow 11%. That is very, very good numbers. This is a good example of a company that is going to do well, at least on average, right? Projections. Obviously, we could be wrong here. We don't know for sure, but if earnings are projected to go up 50%, I mean, even if they're half that, 25% is still extremely good. Like, that's still extremely, extremely good. So I'm very happy with that. If we look at, again, dividend, I'll get into that a little bit later. They are below their historical PE, which I will get into that also when I talk about the valuation. Let's get into the financials here, because this is the most important here. This is the bread and butter. Revenue has gone up consistently every single year, probably going back since 2009 was the bottom. Every year since then, revenue has gone up consistently. Actually looks like 2017-18 it did grow ever so slightly. So again, revenue going up every single year. It hasn't gone up crazy. I mean, 7 billion versus 12 billion over the last 10 years. I mean, that's not even doubling, but that consistent growth is what I like and what I'm looking for. If we look at shares outstanding have trended down. It looks like back in 2021, their shares went way up, but then the last 2 years, they've also been buying back. So I feel like there must have been an acquisition or something that caused that, because I don't see why they would more than double their shares outstanding without something along those lines. Earnings, again, also went down, but they have trended back up the last 2 years, which is what I like. And on top of that, earnings are expected to be up drastically over the next year, which is what you want to see. Past performance doesn't guarantee future performance, but usually once a trend is established, it's safe to assume that it's going to continue unless there's an obvious impediment in its way. And stuff like this is exactly what you want to see. Balance sheet, 37 billion in assets and liabilities of 29. Again, they're an insurance company. Obviously, they're going to have a lot of liabilities. That's not overly concerning, at least in my opinion. If we look at the metrics here, the operating margin and the net margin have trended up. I mean, they're not at record highs, but they have trended up. So that's also what I like to see. If you go back 10 years or so, they never had a net margin above 10%, and they've been above that for 3 years in a row now. So that's good to see. Return on equity, return on invested capital have also both gone up. They actually hit a record high back in 2022, it would have been. 2023, they were down a little bit, but I mean, a return on equity of 18%, return on invested capital of 16%, that's still good. That's not phenomenally good, but that's still good. I don't think anyone would say that that's not a good number, because I would be happy with that number if they simply just maintained that number. Free cash flow per share, book value per share, those are both trending up. Again, they did go down because of the share count change, but they have been trending up for the last 3 years, which is also what you want to see. The dividend. This is something that I really like to see. This is almost a perfect example of what I like to see with a company that pays a dividend. A high dividend is honestly, it's kind of irrelevant, because typically companies that pay 4, 5, 6, 7% dividends, not always, but usually, they have no growth. And a lot of times they have no share price growth, which is what is most important. So if you look at the dividend here, 0.56%, the payout ratio is not even 10%. And another thing you'll notice is that the 10-year growth is just over 9%, the 5-year average growth is just over 10%, and the 3-year average growth is over 11%. So there's a pretty obvious trend here that not only are they increasing their dividend very nicely, but they're actually increasing the rate at which they increase the dividend. So that's exactly what I like to see. And given the payout ratio is below 10%, there is nothing, it is very, very hard to think that they're not going to continue to increase the rate at which they grow that dividend. They probably don't get to like 25, 30% a year, that's probably unrealistic, but I think they could get up to 15. I mean, if you can grow your dividend 15% per year, that means it's doubling about every 5 years. Just under 5 years. So, I mean, if you put that into consideration here, 5 years from now, you're a little over 1%. 10 years from now, you're a little over 2%. 15, 4%. 20 years, 8. 25, assuming they maintain it and you hold it that whole time, you're talking about a 16% dividend, yield on cost. So that's exactly what I like to see. Now, again, it's unlikely you're going to hold a company for 25 years, but I'm just talking about what could happen here. Another very important thing here. Compared to the S&P, they've easily beat the S&P. I mean, going back 10 years, the S&P has returned 222%. They've returned 362%. And with dividends reinvested, you're beating it by even more. So another thing that I really like to see, if we go back 5 years, also has beat the S&P 130 versus 99. So they're also beating the S&P over virtually every single period. And getting back into like the main thing here is that the reason that I like insurance companies, so again, it's obviously not all of them. There's still an extremely low amount that I actually really like. The reason that I like a lot of these companies is they provide very predictable returns. And obviously my opinion here, everything my opinion, but I think they provide, the good ones are going to beat the S&P 500, and they're going to do it in a less volatile, or at the very least, more predictable fashion. Because like I've always said, you still need life insurance in a recession, you still need car insurance, you still need home insurance, et cetera, et cetera, et cetera. Again, obviously you're probably not going to buy quite as good of a car or as nice of a house when you're in a recession, but you still need it at the very least. So that's one of the many reasons that I like insurance companies, and especially a company like this that's fairly well diversified. Now, again, technically you could argue that, the American economy is going to do better than the world economy, blah, 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 blah. But I still like it. I still like it. The last thing to get into here is, okay, we've established that, at least in my opinion, it's a good company. What's a reasonable valuation? So I've basically projected this. So again, this is going based on earnings here. This is assuming a 9% annual earnings growth with zero with zero dilution here. Like, this is assuming shares stay the same. 9% dividend growth with a 15 PE. That means the fair value is basically exactly where it is right now. You're going to return about 10% per year. I think that all of those numbers, if anything, are conservative. Like, their trend is probably like minus 2% share buybacks with, let's say, 11% dividend growth, and 15 PE. Even if you type those numbers in, that means the fair value is 21% above where it's at right now. The average 5-year PE for this company is 18. If you assume that it's an 18, okay, well, the fair value is 45% above where it is right now. I don't think that's necessarily the case. I think that's a little too optimistic, which is why I'm trying to be conservative with these numbers. But that's just what I'm going off here. The last thing to bring up here is the long-term chart of this company. And the one thing you realize is it is a consistent staircase higher. And I mean, if you look back, let's say about 5 years or so, there's been a handful of downtrends after nice uptrends. Back in, 2020, March of 2020, everything came down. Back in 2022, pretty much everything came down. And just recently, it also had a fairly steep, looks like probably a 15% sell-off roughly, and it's trending right back up again. So if you look at the trend here, let's maybe dive a little bit deeper here. They're back in an uptrend here. So I think that, again, this company probably goes back up to between, I'd say, $60 and $70 a share, and then you probably see a little bit of a sell-off again. But if you look at the long-term trend here, it is a consistent staircase higher. And that's exactly what I like to see. Now, again, obviously, the past doesn't guarantee the future, but on average, as long as the fundamentals stay good, the trend is going to continue. So I think that this company is a buy where it's at right now, although keep an eye on the valuation. If it goes back above a 17 or 18 PE, I would probably hold off. But below a 17 PE, or especially a 16, it's at about 15 right now, I think it's a buy. I think it's a clear buy. This is a really good company. If they can simply increase their dividend 11-12% per year, continue buying back the same amount of shares, continue growing their earnings at 9-10% per year, which all of those things I think are easily achievable, this is going to be an absolute no-brainer, So just wanted to talk about this company. This is another solid company that I've never talked about before. If you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.